Welcome to my channel. I'm Scott, and in this video we're going to talk about the oil industry. I'm going to give you some high-level information, then we're going to look at individual stocks, and then at the end we'll talk about ETFs. There are 6 oil and gas industries. The first is drilling. There are 8 companies and the largest is Helmerich & Payne. The average market cap is $1.1 billion. The average dividend yield is 1.5%. I'll show you what the rank is later. These companies own drilling equipment and contract them out to other oil and gas companies. The E&P industry, exploration and production, 85 tickers. The largest is ConocoPhillips. The average market cap is $3 billion. The average yield is 1.9%. And these companies operate in the upstream part of the oil and production process. Upstream is much riskier than midstream or downstream. These companies have to actually locate the oil and pull it from the ground. Then you have equipment and services, 57 tickers. The largest is Schlumberger. The average market cap is $1.9 billion and the average yield is 2.5%. And these companies offer their technology and services to help other companies become more efficient and save money. There are 20 companies in the integrated industry. Exxon is the largest. The average market cap is close to $100 billion. The yield is 3%. And these companies work in every part of the oil and production process. They actually pull the oil from the ground. They refine it. I'm sure you've been to an Exxon gas station. There are 58 midstream companies. The largest is a Canadian company, Enbridge. The average market cap is $7 billion. They have a really high yield of over 5%. Midstream companies store and transport oil. They'll sign an agreement with an upstream company to transport the oil from upstream to downstream. Most of the oil is transported through pipeline, but some companies use trucks or vessels. And the last industry is refining and marketing. There are 23 companies. The largest is Marathon. The average market cap is $23 billion. The average yield is 3.7%. These companies are part of the downstream process. They do the refining of the oil. Let's go over some high-level information before we talk about the individual companies. So generally, an increase in oil prices lowers the expected economic growth and increases inflation. On the flip side, a decrease in oil prices can improve economic growth. But there really needs to be a happy medium where oil companies can make money, where it doesn't cost the end user too much money to buy oil. Because when oil gets really low, like below $50 a barrel, it's really hard for oil companies to make money. But when it gets really high, over $100 a barrel, then everything's so expensive and inflation goes up and the economy starts to detract. And the problem with oil is you cannot replace it in the short term. If it costs you $3 a gallon to buy oil, and next month it costs $10 a gallon, you may find ways to drive less or maybe carpool, but you still need oil to live. Oil tends to be highly inelastic, where something like chicken, if that goes up from $3 a pound to $10 a pound, we can easily switch over to turkey or beef. Most items have plenty of substitutes, but oil, there's really not much. In the long term, you can adjust. If you had a few months or maybe a year, maybe you can buy an EV or retrofit your house to use less oil. And for a lot of people, it's too expensive to make those type of adjustments. It does seem likely the US will ban oil from Russia. And that means lower oil supply and demand will pretty much remain the same. So the only result is higher oil prices. The big positive is the United States is the largest producer of oil. And they've been the largest since 2018, mainly due to fracking technology. Fracking is the process of injecting liquid at high pressure into rocks, and this makes it easier to extract more oil and gas from a location. Russia is the second largest producer of oil in the world. Then you have Saudi Arabia, Iraq, Canada, China, United Arab Emirates, Kuwait, Brazil, and Iran. In 2020, the United States produced 12.1 million barrels of oil per day. You may have heard the term OPEC before. This stands for Organization of the Petroleum Exporting Countries. This consists of 13 of the world's major oil exporting nations. It was founded in 1960 to help manage oil supply and prices. The 5 founding members of OPEC are Iran, Iraq, Kuwait, Saudi Arabia, and Venezuela. The other 8 countries are Algeria, Angola, Congo, Equatorial Guinea, Gabon, Libya, Nigeria, and the United Arab Emirates. The oil benchmarks we use to track the prices are WTI and Brent crude. WTI, or West Texas Intermediate, is oil pulled from U.S. oil fields. Brent crude originates from oil fields in the North Sea between the Shetland Islands and Norway. Both are light and sweet, making them ideal for refining into gasoline. Because oil pulled from the ground cannot be used for anything until it's refined into gasoline, jet fuel, etc. OPEC uses Brent as their pricing benchmark, and 2/3 of the world use Brent as its gauge for oil prices. The US prefers to use WTI as its benchmark. There are 251 tickers in the 6 oil and gas industries, and I ranked all 251. The way I did the ranking is if the company has a market cap above 100 billion, I gave them a score of 4. 50 to 100 billion, 3. 25 to 50 billion, 2. And 10 to 25 billion, 1. If the company has a price to book below 3, I gave them 1 point. A PE below 15, 2 points. A PE 15 to 25, 1 point. If they have a price to free cash flow below 5, I gave them 5 points. A price to free cash flow between 5 and 10 is 4 points. Between 10 and 15, 3 points. Between 15 and 20, 2 points. And between 20 and 25, 1 point. If the company has a price to sales below 1, they get 4 points. Between 1 and 2, 3 points. Between 2 and 3, 2 points. And between 3 and 4, 1 point. The reason I gave points for high market cap companies is because it tends to be less risky to invest in a high market cap company than a micro cap company. Even if a stock is ranked high, it doesn't mean it's a good value. You want to look into it a little deeper. Same thing as when you do a stock screener. If 3 or 4 stocks come up within your parameters, you want to dig into those 3 or 4 a little more. Because some stocks may have great ratios and they're a value trap. Some stocks may have terrible ratios, but they have great growth potential. PetroChina has the most points at 16, then China Petroleum at 15. If I was to do this again, maybe add the field country, and if the company's in China, they may lose points. In terms of risk, maybe a Chinese company with a ranking of 15 is equivalent to a US company with a ranking of 10. If you're a member of my Patreon channel, you get this Excel file and you could change the rankings yourself. I post a lot of my Excel files on my Patreon page. Not the DCF model, but I do plan to post different versions of my Excel DCF model. You'll notice a lot of the higher ranking companies are integrated, which makes sense. These are really big companies and there's a lot less risk investing in an integrated company that's really well capitalized than a company with a market cap below 100 million. Because these two companies with a market cap below 200 million, they have high rankings, but if the capital markets freeze up and they need money to pay off debt or to pay expenses, they may not have access to it. They may not be able to borrow. But a company like Exxon can always borrow money. Maybe the interest rate on the debt would be a little higher during a recession, but they could always borrow. If you bought any of these stocks within the past month or two, you're probably up right now. But you still want to find the ones with the best value because some of these stocks will go up more than others. And when oil comes back to reality, you want to have a really solid company so you don't lose all your gains. And don't wait too long because before you know it, oil could drop a lot and you may not make that much money. So you want to lock in some gains at some point. 3 of these stocks have a dividend over 10%. Energy Transfer owns USAC. Energy Transfer pays a 5.3% dividend. If you own Energy Transfer, then USA Compression's financials are consolidated into theirs. Sprague Resources pays a really high dividend, so does Cross America, and both have a market cap below 1 billion. Midstream companies pay really nice dividends. Most of the dividends are taxed at the ordinary income tax rate, which is the higher tax rate. For a regular company like Exxon, you pay the lower tax rate, long-term capital gains, which is between 0% and 20%. But with an MLP, you may pay over 30% on all your dividends. 9 of the 10 biggest companies are integrated. Some of these integrated companies are known as super majors. I know Exxon, Chevron, Shell, Total Energies, ConocoPhillips, and BP are all super majors. These companies have lots of influence in their industry and also political influence. Free cash flow is a really important number to focus on. This is the cash that's remaining for the investor. And it's hard to compare numbers on a nominal basis because it's pretty much guaranteed a company with above 100 billion market cap will have more free cash flow than a company with below 1 billion market cap. That's why you look at the price of the stock over free cash flow. That's a way to equalize the companies. And generally the lower the better. But it could be a value trap when you see such a good ratio. If I was to invest in these small companies, it would have to be a pretty low percentage of my entire portfolio. The only way I would invest a lot in a small company is if I did a ton of research and I was confident they would grow a lot in the future. And the reason this company with 61 billion market cap and this one with 102 billion market cap have such a good price to free cash flow ratio is because they're in China. But a company like ET, 32 billion market cap with a price to free cash flow of 3.9 looks like a really good deal. This chart shows the price of oil for the past 70 plus years. You can see how cyclical oil is. It's hard to make money holding oil long term. If you catch it on the bottom or close to the bottom, then you can make a nice return. But if you buy it on the higher end, let's say you bought it around 100 and you didn't sell at 140, you would have had to wait 25 years to finally make a profit. You definitely don't want to hold too long because before you know it, oil comes right back down and all your profits go away. You want to take in some of the gains or maybe hedge yourself with options. There are 11 oil ETFs and the largest in terms of assets under management is USO at 3.1 billion, then UCO at 1.5 billion. And you can see all of them made a ton of money the past 3 months, except of course the ETF that's shorting oil. A fund like USO or UCO, they don't hold any oil. They just buy futures contracts to track the price of oil. So they have to keep rolling the contract. Over time, you can't really make money on these ETFs. You want to invest in an ETF that holds actual assets. Just to show you how hard it is to make money on these ETFs, if you invested $10,000 in ticker USO 10 years ago, you'd have $2,400 today. That's a 76% loss. If you invested $10,000 in UCO 10 years ago, you'd have $152 today. That's a 98% loss. For ticker IEO, you'd have $14,000 today. For this ticker, your return is 38%. That's 3.25% per year. For ticker DBO, you'd have 6,000 today, a 40% loss. For ticker BNO, you'd have 7,500 today. That's a 25% loss. For ticker USOI, you'd have $7,300 today, 27% loss. For ticker IEZ, you would have lost 63% of your investment. For ticker SCO, the one way you short oil, you'd have $870 today. That's a 91% loss. You would have lost 17% on ticker USL. Ticker OIL, OIL, is the best by far. If you invested $10,000 10 years ago, you'd have $37,000 today. That's a 269% return. For ticker OILK, OILK, you'd have $9,200 today, an 8% loss. So I hope you learned something new. Let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.